So today's lecture is reading 21, currency exchange rates, and this is the last reading in economics. A quick introduction. The currency market, also generally referred to as the FX market, is the largest market in the world by far. And what do I mean by that? According to the curriculum in 2010, this market was worth about $4 trillion. And just to give you a sense for the context, that is, so this was a day. Okay, so this is per day. And this is 50 times the daily turnover of equities across the world. So the largest equity markets in the world, like New York Stock Exchange, NASDAQ, FTSE, DAX, etc. So take all those markets together, multiply that by 50, and that's the daily turnover of the FX market. So it's huge, and it's immensely important to understand. Even in Pakistan's context, the FX market is pretty large. So in today's lecture, we will get an overview of the organization of the FX market, and then the meat of this reading, where most of the learning objectives come from, is this segment on the mechanics of exchange rates. Then a little word on alternative exchange rate regimes. So you might have heard of regimes which are completely open, free float, such as the dollar-euro exchange rate, which floats with the market, versus at the other extreme you have certain countries that don't even have a currency of their own. Okay, so there is no concept of a exchange rate, because a country like Panama might just use the dollar, or even countries like Greece and Italy in the Eurozone don't have a currency of their own. So we are going to talk about 8 different exchange rate regimes, and then how exchange rates affect a country's international trade. So that's our plan for today. Okay, first, just a quick overview of the FX market. Some of this stuff will be familiar to you, but a lot of people get confused with this material, so I would encourage you to pay a lot of attention, and as long as you get the core concepts, then just have to practice a lot. So let's get started. Currency codes. Every country or every currency has a 3-letter code. So when you see terms like USD, PKR, GBP, so in the international markets, currencies are generally referred to as through these 3-letter codes. Okay, now when a currency is quoted, there is a price currency versus a base currency. I'll say this here and then I will repeat this later because it's extremely important. So when you look at the quote for a dollar, so when you see a quote such as 90 rupees per dollar, then obviously the two currencies involved are the rupee and the dollar. The rupee in this case is the price currency, and the dollar is the base currency. Now how do you figure out which is the base currency? The base currency is the currency that is being quoted. So in 90 rupees per dollar, you are giving the price of $1. So whichever currency is 1 unit, so 90 rupees per dollar, which currency is 1 unit? The dollar is 1 unit. So that is the base currency. Okay, so it is the dollar. So if I say that you have 80 yen per dollar, there again the dollar is the base currency. If I say that the exchange rate is $0.1 to the rupee or $0.01 to the rupee, then in that convention the rupee becomes the base currency. So whichever currency has 1 unit, that's your base currency. The other currency is the price currency. Sometimes it might be called the quoted currency, or so actually for now let's just call it the price currency. There are other terms that will come later. Okay, so keep this in mind. Next point is the nominal exchange rate. This is the exchange rate that you see in the market, in the newspapers, at FX dealers. So this 90 rupees per dollar is an example of a nominal exchange rate. So literally you go to a dealer, give him 90 rupees, he will give you $1. that refers to as your nominal exchange rate. Now, what about the real exchange rate? The real exchange rate also brings in a concept called purchasing power parity. So this means that in real terms, what is the exchange rate? And let me just give you a hypothetical example through the formula. So if you have, let's look at this formula. Real exchange rate D divided by F. In this convention, the D stands for domestic currency and F stands for the foreign currency. So let's take Pakistan's example, where the domestic currency is the rupee and the foreign currency is the dollar. So let's figure out the real exchange rate for the rupee dollar. SD-F stands for the spot rate or the nominal exchange rate, where we are using a D divided by F convention. So D is domestic currency per F. So divided by F, so we have 1 unit of the foreign currency. In my example, the foreign currency is the US dollar. So what should S be? Let's say currently it's about 90. So the spot rate or the nominal exchange rate is 90 rupees to the dollar. Then PF refers to price levels in the foreign market, the foreign market being the US market. Very simplistically, you can think of this as the prices and the salaries. So a combination of prices slash incomes in the foreign market, which is the US. Let's say that your price index in the US is 1. So just take that as a given right now. And let's say that the price in Pakistan, the price level is 90. And to illustrate this with a simple example, let's just say that prices in the US and Pakistan are represented by squash balls. So I like to play squash, so I'll give you an example in the context of a squash ball. So if the squash ball mirrors prices or is an indicator of prices across the US and across Pakistan, let's say that in the US a squash ball costs $1. So that's where this 1 is coming from. And in Pakistan a squash ball costs 90 rupees. So that's where this 90 is coming from. Okay, then what is the real exchange rate in this example? The real exchange rate is simply 1. Okay, let's say we are starting at this base. Now, let's say the prices remain the same. So the price level in America stays at 1. The price level in Pakistan stays at 90. But the nominal exchange rate, this 90, goes up. So this goes from 90 to 95. That means the real exchange rate is going up. As long if prices are the same, but this number goes up to 95. Now, when an exchange rate goes up, which currency is strengthening? The dollar is strengthening. The base currency, whenever the value of the currency or this number goes up, it's the base currency that is strengthening. Why? Because now we are saying that it now takes 95 rupees to buy a dollar. Okay, so the base currency is strengthening. So when the base currency is strengthening, assuming price levels stay the same, we can say that even in real terms, the dollar has strengthened. Okay, now this one, okay, now next scenario is 90 stays the same, but the price levels in the US go up. And remember, when I said price levels, I'm referring to incomes, prices, everything. So and here it is simpler to think in terms of income. So let's say incomes go up by 10% in the US. So if incomes in the US go up by 10%, but everything else, the spot rate stays the same, Pakistani prices stay the same, aren't Americans more able to buy in Pakistan? So Pakistani goods become cheaper for them. That means in real terms, the US dollar has strengthened, because for Americans it becomes cheaper to buy squash balls and whatever else in Pakistan. Okay, then next scenario, let's say 90 remains the same, the price levels, incomes in the US stay the same, but prices in Pakistan go up. the price levels in Pakistan go up. If price levels in Pakistan go up, then it becomes more expensive for Americans to buy in Pakistan. That means the dollar has weakened. So in that case, notice if the price levels in Pakistan go from 90 to 95, then the dollar has weakened and the rupee has strengthened. Now, whether or not you fully comprehended that, and a lot of people, this takes a little bit of time to sink in, but what must you do right now, and write this down because you will be tested on this on the next slide. So the real exchange rate is equal to your spot exchange rate multiplied by the price level in the foreign currency divided by the price level in the domestic currency. So that's the formula for the real exchange rate, where the convention that we are using both for the real rate and the spot rate is the domestic currency divided by the foreign currency. So notice one thing. So so domestic over foreign. So if the real rate is domestic divided by foreign, that means the foreign is the base. Then for the spot rate also the foreign currency is the base. But the price level is, the numerator is the foreign currency, which in our example is the base currency, and the denominator is the domestic currency, which in our example is the price currency. Whenever you forget this, what do? You just remember it in terms of this very silly and simple example. Okay, if this example is anchored in your head, you will not forget this point. Okay, now we'll do this example number 1 from the curriculum. So I'll read with you. An investment advisor located in Sydney, Australia is meeting with a local client who is looking to diversify her domestic bond portfolio by adding investments in fixed rate long-term bonds denominated in Hong Kong dollars. So your client is sitting in Australia, so concerned about how the Australian currency is doing, and invests in the Hong Kong dollar. Okay, your client is over here in Australia. The client frequently visits Hong Kong, and many of her annual expenses are denominated in Hong Kong dollars. The client, however, is concerned about the foreign currency risk of offshore investments and whether the investment return on her Hong Kong denominated investment will maintain her purchasing power, both domestically, i.e. for Australia denominated expenses, and in terms of her foreign trips, that means Hong Kong denominated. So when she goes on these trips, let's say she pays in Hong Kong dollars. The investment advisor explains the effect of changes in nominal and real exchange rates to the client and illustrates this explanation by making the following statements. So these are the statements, and based on what you just learned, we need to figure out whether these statements are true or false. And these are classic CFA type questions. Increase in nominal Australian dollar divided by Hong Kong dollar rate will lead to increase in Australian denominated investments. Okay, so let's look at this carefully. So what's the base currency here? Which currency are we?
Hong Kong dollar.
Yeah, what did I just say? The base currency is the one that's in the denominator. So whenever you have Australian dollar divided by Hong Kong dollar, that means we have 1 unit of Hong Kong dollar. So I don't know what these rates are, but let's say Australian dollar to Hong Kong dollar, let's just pick a number, let's say that's 2. This means that 2 Australian dollars for 1 Hong Kong dollar. 1 Hong Kong dollar, that means Hong Kong dollar is the base currency. In our example also, if your client is Australian, then from her perspective, what's the foreign, what's the domestic? So Hong Kong is the foreign. So like on the previous slide, the base currency is the foreign currency. Okay, so let's just get that straight. So increase in the nominal rate. So increase in nominal rate means that Australian dollar is strengthening or Hong Kong dollar is strengthening?
Hong Kong dollar.
So increase in this rate. Now your analogy is Pakistan. So what's the current rate? It's 90 rupees per dollar. When this number goes up, is the domestic currency strengthening or is the foreign currency? Foreign currency is strengthening. So dollar is strengthening. So in this case, increase in the nominal rate, whatever that rate may be, if that rate increases, what's strengthening? The Australian dollar or Hong Kong dollar? Okay, I'll make everybody get this right, and it's normal to be confused here. So again, I'll come back to this. Here, the base currency is the US dollar, and the domestic currency is the rupee. When this number goes up to 95, which currency is strengthening? The base, okay, the base currency, which is the dollar. Okay. Now, if the nominal rate increases, which currency should strengthen? The one in the denominator, which is the base, or the numerator? The denominator. So, exactly. So if there is an increase in the nominal rate, that means the Hong Kong dollar has strengthened. So an increase. An increase in the nominal rate will lead to increase in Australian denominated investment. The point here, and when you read this in the explanation, so the person here, the context here is that she's investing in Hong Kong bonds. Okay, so if she's investing in Hong Kong, let's imagine that you are that investor. If you are investing in Hong Kong and the Hong Kong currency strengthens, does that make you happier? Yeah, so let's just imagine that in the context of that Hong Kong investment, you are happier because you invested in another country. Whatever happens to that investment, hopefully that investment is going up, but if the currency is also strengthening, then that's double goodness for you. Okay, the currency is also strengthened. So that means your buying power in Australia will go up. Right? So this is a good thing, and that's correct. Increase in the nominal Australian dollar to Hong Kong rate, again, so increase in this rate again means that the Hong Kong dollar is strengthening, means that the relative purchasing power of Hong Kong trips will increase. So you are paying for those Hong Kong trips in Hong Kong dollars. Is it good for you or bad for you, or are you indifferent in terms of your paying for the Hong Kong trips in Hong Kong dollars? You are indifferent because there it doesn't matter whether the currency is appreciating or depreciating. If you have money in Hong Kong and you are paying, their exchange rate doesn't come into play. So this statement is false. You should be indifferent. Okay. What about the third statement? Increase in the Australian price level will increase the real Australian dollar to Hong Kong dollar rate. What does this mean? So increase in the Australian dollar price, so price level. So what was so at this point we need to go back and refresh our equation. So our real exchange rate was equal to the spot or the nominal exchange rate times the two price levels. Now this exchange rate was expressed as domestic over foreign. This is also expressed as domestic over foreign. And this numerator was which one? The foreign price level? This was the foreign price level, and this is the domestic price level. So now what are they saying? So increase in Australian dollar price level. Australian dollar is domestic. So if this denominator goes up, what happens to the real rate? So the real rate has gone down. So this going down means what? Means that so does it mean that the domestic currency has strengthened or the foreign currency has strengthened? So when the number goes down, so imagine, just go back to Pakistan. So when the exchange rate declines, it's the domestic currency that has strengthened. So So when this rate goes down, the domestic currency, which is the Australian dollar in this context, that's what strengthens. Okay, so will increase the Australian dollar. So is this a true statement or incorrect? This is false because that real rate is actually going down. So that statement is false. Decrease in nominal Australian dollar to Hong Kong dollar rate. That means, so now we are saying that this rate is going up. So if the spot rate goes up, decrease, I'm sorry. So that is going down. So decrease in the nominal Australian dollar Hong Kong dollar rate will decrease the real rate. So that will decrease the real rate. Is that correct? And increase the relative purchasing power of the Australian income. Okay. So this first part is correct. What about the second part? And increase the relative purchasing power of Australian income. Is this true?
Yes.
Yeah, this is true. Why? Because if this number is going down, that means your domestic currency, which is the Australian dollar, is strengthening. So when a currency in real terms strengthening, that means that the purchasing power of that currency is up. Okay, so I think this is a great question, and if you are to be tested on something like this, it will be probably very similar to what you are seeing here. So I've covered the main points, and then there are a couple of more questions 5 and 6 in this example, which you need to do as homework. So I need you to go back and study this example because it's great. If you found this clip interesting and informative, please visit my website www.arifirfanullah.com. Here you will find a tremendous amount of useful material. Right here in the 2011 CFA video lecture series, you will find the entire level 1 curriculum for free, and most of the material here is still relevant. So this is worth looking at. The 2012 video lecture series covers both level 1 and level 2. These lectures are available for a fee. And finally, down here, financial management at IBA. Here you will find my lectures at IBA for a course on financial management. Plus you'll find lots of useful spreadsheets that can help you with financial modeling. So again, please visit www.arifirfanullah.com. Thank you.